Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
First and foremost, start about, just the basics. What is the difference between commercial and residential financing?
Yes, big difference. And let's first define what commercial is. Okay, so if you're looking at a multi-unit starting at 5 units, 5 and 6 units are in the gray zone. Some lenders actually will approve the deal as residential. Very few lenders will do that, but the majority of the lenders starting at 5 units start to look at approvals differently. What they do is, Sarah, they look at the multi as if it's a business. They see what that building will qualify for in terms of a mortgage versus looking at your personal income as an investor, your credit as an investor. So we have investors who actually earn no income whatsoever personally, and they're scaling up into multi-residential. Why? Because the lenders look at the ability of the asset to qualify for the mortgage. And we will get into that a little later, but that's in a nutshell how they get the loan approved. It's the building that qualifies, not you personally.
And I think that is something that, if somebody's listening to this right now and saying, my income isn't that high, or for some reason, they are no longer working with a T4 income or started their own business, it is going to be an avenue, I think, that people can take to go this route versus trying to go through the 1 to 4 unit where, you might be capped out. And so you wonder, and I think a lot of people wonder, how do you get to so many properties? How do people get to so many properties? And then, maybe they become full-time, they don't have an income anymore. This is one of those strategies that they can utilize to be able to keep scaling their portfolio with multifamily commercial types of units.
Yes, and there is one thing I'd like to share that not too many investors know about. Investors think that at 5 units, this is how the lenders start to look at deals. But here is a tip. We have done deals in the 2 and 3 and 4 units category using this philosophy of looking at the deal versus individual income. And that's how also some investors can still play in the smaller arena and qualify for mortgages even if they don't have personal income, because the methodology used is using commercial financing versus the typical residential finance, although the property is residential.
I mean, I think that's a great tip, because I don't think I knew this until you mentioned it. I mean, maybe it's a year or two ago now that you have the ability to take a 2, 3, 4 units. Maybe you're doing a small conversion, something along those lines, and you don't have to qualify. So that's interesting. So let's just take a moment and just talk about that for a second, because, let's just say you buy something, I don't know, I'll pick a market. Let's just say Hamilton, and it's going to be a single family conversion to 2 or 3 or 4 units.
Yes.
What does that look like from your end in terms of financing, where something like that would make sense? Like, is there a debt coverage ratio? Like maybe just walk us through some more insights on that.
Yes. So basically, we as a first option for investors who are buying a single or a duplex or a triplex or a fourplex, I'm always trying to get them the best cost of money, right? And that's typically residential, because you get 30-year M, you don't do expensive appraisals, you can get up to 80% loan to value. But if there is no option under that methodology, we look at commercial, which is the debt coverage method. And this is where we basically run the numbers on a duplex and say, okay, what is the total income that this duplex is going to generate? Let's account for some vacancies, and we use 5% as a guideline. And then we deduct taxes, insurance, repairs and maintenance, utilities, and property management, and we arrive to something called net operating income. We actually have a calculator that we developed, so people don't have to remember all of this. They can just email us for our multi-residential tools at info@streetwisemortgages.com, and they can get a copy of this calculator. But essentially, you take the duplex, run it through the calculator, and see how much mortgage it will qualify for based on its debt coverage. So the maximum you can get on a smaller property is 75% of the value, unless you start to go to CMHC for 5 units and above. So we've used this, Sarah, for investors who show no income or cannot qualify on the residential side. So just to give you an example, very powerful. We have investors who pick up these properties with private money. Essentially, they fix them up, they increase the income. We know going into the deal what the debt coverage will be, and we refinance them commercial. So essentially, they're picking up with private and they're exiting commercial.
That's brilliant, right? I mean, and you just mentioned that there's a free calculator. I think people should definitely go download that. So you could have a 2, 3, or 4 units, be a full-time real estate investor, quit your job a little too early, which is totally fine, you know, but you have these options and you run through the property. So you're talking about a 25% down, 75% loan to value. You know, what are we looking for, like amortization? Usually I'm guessing rates are a little bit higher as well from a commercial standpoint.
Yes, so there are a couple of things you need to account for in commercial. First of all, rates are a little higher right now. You know, you're looking at a 3.5% roughly in terms of a rate. Your appraisal is going to be a little bit more expensive because the commercial lenders look for a more in-depth appraisal on the property. So you're going to spend, you know, versus if on a residential deal you're spending $300 on an appraisal, on a commercial deal, depending on the size of the building, you may be in the 750 and above, depending on how many units. And then some lenders charge a fee. It ranges from 0.25 to potentially 1%. And then the broker charges a fee because on commercial deals or deals that are approved using the commercial methodology, brokers don't get paid from the lenders the way residential lenders pay brokers. So these are costs that the investor needs to account for. But if you cannot get it financed residentially, guys, you know, it's worth your while to go commercial, even though the costs are higher. And that's the trick.
Right. So probably a little bit more down payments, a little bit higher cost, but if the deal makes sense, the deal makes sense. And if this is your other option other than just staying with private money, it's probably a better option. Where have you seen these work the best? Like, is it when you're doing the conversions? Is it 4 units, 3 units, duplexes, singles? Like, where are you seeing where you're saying this works the best in these types of properties?
Okay, so generally speaking, the more units there are, the more income we have, and the better the property debt covers, and therefore we can get a good loan amount on it on the commercial side. If we're dealing with a smaller property like a duplex or a triplex, if you're in major markets, often they don't debt cover well. So you can still get it financed commercially, but you may not get to the full 75%. But what I do sometimes to make the numbers work, I can take a duplex and a triplex and present them to the lender as if they are a 5-plex. And therefore I'm dealing with more units and I can help the numbers and therefore get you a mortgage on these two at a higher loan amount. So there are tricks to make the numbers work that way, but generally the more units we have, the better it works from a commercial standing point.
That is really interesting. So essentially, is it 2 properties that you could buy together at the same time, or could it be something else in your portfolio that you have that you could add to what you're currently buying?
Either or.
Okay.
Either or. Yeah. The key thing that we have to remember on commercial deals, Sarah, is that the income of the property is what is going to qualify it for the loan. So if the property is going to be vacant on closing, or there are vacant units, that will impact the numbers, right? Think about it as the property earning, like the property is in a job technically. If it's not earning money through its job, it cannot qualify for the mortgage. So we cannot get the loan up if the units are vacant. They have to be occupied on closing. But yes, I can combine 2 duplexes or a duplex and a triplex to make it like a 5 units or 4 units.
I mean, that's brilliant. Like, you know, anybody that's listening to this right now, that is your key tip. I'm sure there'll be lots of key tips, but this is like gold mine material right there. And ultimately here's how you keep scaling. You don't have to have a T4 job. You don't have to have an income. You just need to make sure that the income from the property, from the commercial property, supports itself. So I'm guessing, because like obviously as a real estate investor, to play devil's advocate, if something is vacant, I prefer that because I can renovate it. I can put my own rent. So do you think that it might make more sense than to close privately, get everything put together, and then go to the commercial route for the exit?
Absolutely. That's actually the most attractive model when it comes to multi-residential. Don't let the vacancy scare you. If you know how you're going to renovate it and what your potential income is going to look like, yes, we pick it up with private money. You sit on this money for the duration of the renovation, and then we refinance it commercial. But we got to run these numbers, Sarah, upfront going into the deal, right? You don't want to assume you will be able to get 75% financing once the work is done and then get surprises later. So all of this planning and numbers crunching happens upfront. But yes, generally, you pick up with private, you exit commercial, and it's a beautiful model for scaling that way.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larbi. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?